excuse me, is a lot of times people buy on the basis the stock has gone down this much. How much further can it go down? I remember when Polaroid went from 130 to 100. People said, "Here's this great company, great record. If it ever gets below 100, just buy every share." And it did get below 100. A lot of people bought on that basis, saying, "Look, it's gone from 135 to 100. It's now 95. What a buy!" Within a year, it was 18. And this is a company with no debt. This is a company. It was just so overpriced. It went down. I did the same thing in my, I think my first or second year of Fidelity. Kaiser Industries had gone from $26 a share to 16. I said, "How much lower can it go?" It's 16. So I think we bought one of the biggest blocks ever on the American Stock Exchange of Kaiser Industries at 14. I said, "It's gone from 26 to 16. How much lower can it go?" Well, at 10, I called my mother and said, "Mom, you got to look at this Kaiser Industries. How much lower can it go? It's gone from 26 to 10." Well, it went to 6, it went to 5, it went to 4, it went to 3. And fortunately, this happened rapidly, or I would probably be still caddying or working at the Stop and Shop, but it happened fast. So I was able to, it was compressed. And at 3, I figured out, there's something very wrong here, because Kaiser Industries owns 40% of Kaiser Steel, they own 40% of Kaiser Aluminum, they own 32% of Kaiser Cement, they own Kaiser Broadcasting, they own Kaiser Sand and Gravel, Kaiser Engineers, they own Jeep, they own business after business, and they had no debt. Now, I learned this very early. This might be a breakthrough for some people. It's very hard to go bankrupt if you don't have any debt. It's tricky. Some people can approach that. It's a real achievement. But they had no debt, and the whole company at 3 was selling at about $75 million. At that point, it was equal to buying one Boeing 747. I said, "There's something wrong with this company selling for $75 million. I was a little premature at 16, but I said everything's fine, and eventually this will work out. And what they did is they gave away all their shares to their shareholders. They passed out shares. They passed out their public shares in Kaiser Steel. They sold all the other businesses, and you get about $50 a share. But if you didn't understand the company, if you were just buying on the fact the stock had gone from 26 to 16, and then it got to 10, what would you do when it went to 9? What would you do when it went to 8? What would you do when it went to 7? This is the problem that people have, is they sell stocks because they didn't know why they bought it, then it went down, and they don't know what to do now. Do you flip a coin? Do you walk around the block? What do you do? Psychiatrists haven't worked so far. I've never seen them running in. The Psychological Psychiatry Fund, I've never seen listed for with the SEC to make it through as a mutual fund. So they haven't seemed to help. I've tried prayer. That hasn't worked. So if you don't understand the company, you have this problem when they go down. Eventually, they always come back. This one doesn't work either. People think RCA just about got back to its 1929 high when General Electric took it over. A lot of double nits never came back. Remember those beauties? Floppy disks, Western Union, the list goes on and on. People saying it'll come back. Well, it doesn't have to come back. Here's another one you hear all the time. It's $3. How much can I lose? I've had people call me up saying, "I'm thinking of buying this stock at 3. How much can I lose?" Well, again, you may need a piece of paper for this, but if you put if you put $20,000 in a stock at 50, or your neighbor put $20,000 at 50 into the stock, and you put $20,000 in at 3, and it goes to 0, you lose exactly the same amount of money. Everything. And people say it's 3. How much can I lose? Well, if you put $1 million on it, you can lose $1 million. Just the fact that stock, this may be a reason to research a stock. The fact that stock is 3 down from 100 doesn't mean you should buy it. And in fact, short sellers, people that really make money in stocks, they don't short Walmart, they don't short Home Depot, they don't short the great companies, Johnson & Johnson. They short stocks down from 80 to 7. They'd like to short it at 16 or 22, but they figured out at 7 that this company is going to go to 0. They just haven't blown taps on this thing yet. It's going to 0.
Peter Lynch explains the psychological traps investors often fall into when stock prices decline. He uses his own experience with Kaiser Industries' stock price decline as an example to illustrate the dangers of blindly buying into the bottom of the market. When the stock price of Kaiser Industries plummeted from $26 to $16, many people hastily bought it, assuming it couldn't fall any further. However, Lynch witnessed the stock price continue to decline. Through this experience, Lynch learned that stock prices can decline unexpectedly and that impulsive purchases can lead to significant losses. He emphasizes that a declining stock price doesn't necessarily mean it's a buying opportunity. Lynch stresses the importance of thoroughly understanding a company and carefully assessing its future prospects before investing. He cautions that blindly buying into the bottom can cloud an investor's judgment and result in substantial losses. Furthermore, Lynch explains that short sellers have a different perspective on the market compared to those who impulsively buy into the bottom. Short sellers identify companies with poor future prospects and profit by selling their stocks short, anticipating a decline in price.